Good day everyone. At last we are moving to the next section of your cash flow statement, and that is your investing activities section. Now this, if you look at your entries here, you will see all of them are non-current assets. So this is the section where you will accommodate your non-current assets and nothing else. Assets sold and assets purchased, and remember, investment is also a non-current asset. So what you do is you go to your statement of financial position, your balance sheet, you compare last year's closing balance, which is this year's opening balance, to this year's closing balance. So you compare the opening and the closing balances of this financial year. Now sometimes it's simple. If you go to land and buildings, which is a non-depreciable asset, you can just look at the figure to determine whether there was an acquisition. For instance, if the opening balance was 500,000 and now at year end it's 600,000, and they say that there was no sale of land and buildings, then you will have 100,000 purchase, which is an outflow of cash. So in your cash flow statement, you will indicate it by brackets to show that it was an outflow. If you compare the opening and the closing balance, and the closing balance is less than the opening balance, and they tell us that there was no purchase of land and buildings, then it means that that difference between the opening and the balance and the closing balance was a sale. So say for instance the opening balance is 1 million rand, and at the end of the year it's 800,000 rand, then there was a disposal of 200,000. When you disposed, when you sell, cash is flowing in, so therefore plus 200,000. It becomes more tricky when you go to plant and machinery and vehicles and equipment, your depreciable items, because now you have to take into account your depreciation as well as soon as there is a disposal, because you must dispose of your depreciation as well, and it will interfere with your profit and your loss. So therefore we are going to do T accounts. I will advise you to do T accounts when there is a sale of an asset, a depreciable asset, and you have to open your asset cost price account, your accumulated depreciation for that asset account, as well as your disposal account. It can also be quite simple if I just say, for instance, that there's no sale on plant and machinery, and you look at your plant and machinery opening and closing balance, and it's, for instance, say 800,000 rand for an opening balance and 900,000 for a closing balance, then you know that there was a purchase of 100,000 and cash was flowing out. So minus 100,000 here. Before we do the T accounts, I just want to draw your attention to the investments. Investment is also a non-current asset. So if there's an acquisition of investments, it means that cash was taken from our bank account and it was invested in, say, a fixed deposit of ABC Bank, and some cash was flowing out, therefore brackets. On the other hand, when there's a decrease in your investments, it means that an investment was sold and money was flowing in, so it will be a plus here. Cash was flowing in from that investment sold to our current bank account. Now, as I said, the problem is when there's a disposal of a depreciable asset. So you have a few steps. In the first place, the current year's depreciation you must bring into, you must update that. So you debit your depreciation, you credit your accumulated depreciation for that particular asset. This is nothing new to you. Then you open your assets disposal account. You credit the cost of the asset. You go to the cost of asset account on the credit side. You dispose of that asset's cost and you enter it on the debit side of the assets disposal account. You do the same with the accumulated depreciation. On the debit side of the accumulated depreciation for the assets, you remove that the disposed assets depreciation, and the entries then on the credit side of the assets disposal account. Then, now for the proceeds of this transaction, you can debit your bank account if it was a cash transaction, or your debtors if it was a credit transaction, or your creditors if it was a trade-in. And you credit your assets disposal account. So now, so far, you have 3 items on your assets disposal account. If you balance this assets disposal account, you will know whether there's a profit, which will be shown up on the debit side of your assets disposal account, or if it was a loss, you will see that on the credit side of your assets disposal account. Here you can see your assets disposal account. This is just a random example. The assets disposal account, on the debit side you see the cost price, on the credit side the accumulated depreciation for this particular asset. Then what it was sold for, and the loss made. You balance the account and this was the loss made. Remember, this bank amount will be the one that you enter in your cash flow statement as an inflow on this sale. Let's look at an example. Example 7. Say the cost of a motor vehicle is 750,000 and the accumulated depreciation till the date of sale is 450,000 and your selling price, it was for cash, 200,000. Calculate the profit or the loss on this sale. So you will draw up your assets disposal account to determine that. There's your 750 minus your 450 equals your book value. Cost less accumulated depreciation equals book value or carrying amount. Now if you sell the asset for more than your book value, it's a profit. If you sell it for less than the book value, it's a loss. Like in this case, the book value was 300. You sell it for 200,000. So then there is a loss of 100,000. Or you can see that also in your assets disposal account. There it is, cost on the debit side, accumulated depreciation on the credit side. The 200,000 you receive from this transaction, you balance the account and it turns out that there's a loss of 100,000. If we go to example 8, the cost of the plant is 1.5 million. The accumulated depreciation up to date is 370,000. Selling price we don't know, but we know that there's a profit on the sale of 960,000. Calculate the selling price, the cash received. Now if you look at the solution, the cost is 1.5 million less your accumulated depreciation equals your book value. Now you know that you sell it for 960 profit, so you sell it for 960,000 rand more than the book value. So therefore the selling price or the proceeds must be 2.5 090 million. Now the profit, or if there's a loss, will be under your non-cash items in your calculation for cash generated from operations. And remember, your selling price, the proceeds, will go to the face of your cash flow under the investing activities section. You can also see this in the account. The account on the debit side is the 1.5 million. On the credit side, your accumulated depreciation. You know that there's a profit of 960. So when you balance the account, you get your selling price. So any of these items can be left out, but you will be provided with at least 3 of these entries.